What if I told you that a single revision in the UK economy could affect your job, your savings, and even the price of your groceries, no matter where you live? Today, the UK government revised its economic growth figures downward, and this is not just a British problem. This decision sends shockwaves across global markets, trade, currencies, and consumer confidence. So stay with me, because in the next 10 minutes, you'll understand why UK growth was revised down, what it really means behind the headlines, and most importantly, how this impacts people just like you all around the world. So what does economic growth revised down actually mean? It sounds complicated, but it's pretty simple. Economic growth is usually measured by something called GDP, or gross domestic product. It's the total value of everything a country produces. When growth is revised down, it means the economy didn't grow as fast as everyone originally thought. In some areas, it might not have grown at all. Governments and statisticians often release early estimates to give us a quick snapshot. Later, when all the real, accurate data comes in, they revise those numbers. In this case, the UK's growth outlook for the recent period has been cut, and that's raising some serious concerns about its economic stability. So, why the downgrade? What's actually happening behind the scenes? There are 5 major reasons. First, high interest rates. To fight off soaring inflation, the Bank of England has kept interest rates high. Think of it like putting the brakes on the economy. This makes mortgages more expensive for homeowners, makes it harder for businesses to get loans to expand, and ultimately, it makes everyone think twice before spending money. Which brings me to reason number 2. Weak consumer spending. UK households are tightening their belts. Energy prices are still high, food costs have jumped, and rent or housing costs have risen sharply. When people have less disposable income, they spend less on everything from new cars to nights out. And less spending directly translates to slower economic growth. Third, we have sluggish business investment. When the future looks uncertain, companies get nervous. They delay or even cancel big projects and investments. Why build a new factory or hire more staff if you're worried about rising costs and lower profits? This lack of investment is a huge drag on the economy. The fourth reason is the global trade slowdown. The UK is a trading nation. It depends heavily on selling its goods and services to other countries. With slower growth happening in major economies like Europe, China, and the US, there's just less demand for British exports. It's like trying to run a shop when fewer customers are walking through the door. And finally, number 5, post-Brexit structural challenges. Leaving the European Union has created ongoing friction. Things like new trade rules, labor shortages in key industries, and different regulations continue to create hurdles for businesses, impacting their productivity and growth. Now, you might be sitting there thinking, okay, that's tough for the UK, but why should I care if I live in the US or India or Australia? Great question. The UK economy's impact stretches far beyond its borders. First, let's talk about global financial markets. London is one of the world's biggest financial hubs, right up there with New York and Hong Kong. When the UK's economy slows down, global investors get cautious. They might pull their money out of riskier assets, which can cause stock markets around the world to feel the pressure. This creates volatility that can affect your own investment portfolio. Then there's the impact on the British pound. A weaker UK economy usually means a weaker pound. This has a ripple effect. It changes the prices of imports and exports, not just for the UK, but for all of its trading partners. It can even affect inflation in other countries depending on how their currencies stack up against the pound. If you're traveling or doing business internationally, these currency swings matter. Next up is the international trade chain. Many countries and companies rely on the UK for imports, exports, and critical services like finance and consulting. A slowdown in the UK can disrupt supply chains, affecting manufacturing, logistics, and the availability of certain goods across the globe. And finally, global banking and investment. UK-based banks and investment funds operate all over the world. An economic slowdown at home can lead them to tighten credit, making it harder for businesses and individuals everywhere to get loans. It can also reduce the flow of investment into other countries. This isn't just about numbers on a chart. It has real-world consequences for ordinary people. For those living in the UK, it can mean slower wage growth, fewer job opportunities opening up, and continued pressure from the rising cost of living. For people outside the UK, the effects are more indirect but still significant. You might see it in currency exchange rates when you travel or buy things online. It could lead to higher prices for imported goods that come from or pass through the UK. It might even mean reduced job opportunities in global companies that are scaling back due to a weaker economic outlook. When a major economy like the UK struggles, global confidence takes a hit, and that slows down momentum for everyone. So, what can be done about it? What will the UK government and the Bank of England do next? They're in a tricky spot. One possibility is interest rate cuts. If growth stays weak, the Bank of England might decide to lower interest rates to make borrowing cheaper again. This would encourage people and businesses to spend and invest, hopefully kickstarting the economy. The government could also step in with spending and stimulus. This might look like investing in big infrastructure projects like new railways or green energy, offering support to struggling businesses, or even providing tax relief to households to boost their spending power. But here is the big challenge. It's a delicate balancing act between fighting inflation and promoting growth. If they cut interest rates too early, they risk inflation flaring up again. But if they wait too long, they risk pushing the economy into a deeper slowdown. This decision is being watched closely by global investors and markets because it will set the tone for what's to come. So what happens next? What's the global outlook? Economists everywhere are keeping a close eye on a few key indicators: inflation trends, wage growth, consumer confidence, and the recovery of global trade. If the UK can stabilize its economy, it would be a positive sign for Europe and could help global markets regain some momentum. However, if it weakens further, it could contribute to a broader global slowdown, with some analysts worrying about the impact stretching into 2026. The revision of the UK's economic growth is more than just a dry statistic. It's a powerful reminder of just how interconnected and fragile our global economy really is. What happens in the UK definitely does not stay in the UK. It affects markets, currencies, jobs, and the cost of everyday life for millions of people worldwide. It shows us that we're all in this together. So, what do you think? Will the UK manage a quick recovery, or are we heading for a deeper, more prolonged slowdown? Let me know your thoughts down in the comments. If this video helped you understand global economics a little better, please give it a like, share it with a friend, and make sure you subscribe for more real-world financial insights. Thanks for watching.